One investor has 30% more money after 20 years. Same index, same start year, same amount invested. 5 invisible decisions made the difference. Here is what nobody tells you before you buy your first ETF. Mike Petrie covers the philosophy on Nobody Told Mike. This is the technical layer, the practical checklist for investing for beginners that nobody hands you first. Nobody Told Mike tells the stories. Here we break down the numbers. Here is the problem. When most people search for the best ETFs, they find one that tracks the S&P 500 and buy it. Reasonable starting point. But 2 ETFs tracking the exact same index, the same 500 companies, the same weightings, can produce wildly different outcomes over 20 years. Not because of the index, because of the structure around it. The structure determines how dividends are handled, how much tax you pay, which regulations apply, where the fund is domiciled, and whether it actually owns the stocks it claims to own. 5 decisions. Most investors never make them consciously. Checkpoint 1. Accumulating versus distributing. The first and most important decision for a long-term investor. Every ETF that holds dividend-paying companies receives dividend payments from those companies throughout the year. What the ETF does with those dividends determines everything. A distributing ETF pays the dividends out to you as cash, directly into your brokerage account. That sounds appealing. But in most European countries, that cash payment is a taxable event. Every dividend payment triggers a tax liability in the year it is received, even if you immediately reinvest it. An accumulating ETF does not pay dividends out. It automatically reinvests them back into the fund. The dividends compound inside the ETF, tax deferred, no action required, no taxable event until you eventually sell. For a growth phase investor, someone building toward a target like Mike Petrie's €1 million goal on Nobody Told Mike, accumulating wins almost every time. The compounding runs uninterrupted. The tax bill is deferred for decades. The difference over 20 years is significant. Distributing makes sense only when you actually need the income, when you are in Mike's income phase, not his growth phase. The label to look for: a CC for accumulating, DIST or DIS for distributing. Checkpoint 2, the real cost of an ETF. Most people check one number when evaluating an ETF: the TER, the total expense ratio, the annual management fee. For a good index ETF, that should be between 0.03 and 0.20% per year. But the TER is not the full cost of owning an ETF. There are 4 costs most people never calculate. The first is the spread, the difference between the buy price and the sell price when you transact. On a liquid ETF, this is small. On a less liquid ETF, it can be significant. The second is the transaction fee charged by your broker every time you buy or sell. Some brokers charge nothing. Others charge 5 to 10 euros per transaction. On a monthly investment plan that adds up. The third is currency conversion. If you are buying a USD-denominated ETF with euros, your broker converts the currency at a rate that includes a margin. That margin is a cost most people never see. The fourth is tracking error, the difference between the ETF's actual return and the index it is supposed to track. A well-run ETF has minimal tracking error. A poorly run one quietly underperforms its index year after year. The real annual cost of an ETF is TER plus spread, plus transaction fees, plus currency conversion, plus tracking error. Most investors only see the first number. If checkpoint 3 just saved you 15% on dividend withholding tax you did not know existed, hit like. That is real money, recovered by one decision. Checkpoint 3, domicile. Why Ireland matters. Every ETF has a legal home, the country where the fund is registered. For European investors, domicile is a tax efficiency question that most beginners never ask. The most important domicile for European ETF investors is Ireland. Here is why. When a European ETF holds US stocks, like an S&P 500 ETF, those US companies pay dividends. The US government withholds tax on those dividends before they reach the ETF. For ETFs domiciled in Ireland, that withholding tax rate is 15%. the result of a tax treaty between Ireland and the United States. For ETFs domiciled elsewhere in Europe, the withholding rate can be 30% or higher. On a large portfolio, that 15% difference on dividend income compounds into a significant gap over decades. Look for the fund domicile in the ETF's full name or fact sheet. Irish domiciled ETFs typically show IE in their ISIN code, the unique identifier for each fund. Checkpoint 4. UCITS, the European Investors Framework. If you are a European investor, you cannot legally buy the most famous ETFs in the world. VOO, Vanguard's S&P 500 ETF. QQQ, the NASDAQ 100 ETF. SPY, the original S&P 500 ETF. All available to U.S. investors. None legally available to retail investors in Europe. The reason is UCITS, Undertakings for Collective Investment in Transferable Securities, the European regulatory framework governing funds sold to European retail investors. U.S.-listed ETFs are not UCITS compliant. This is not a problem. It is a filter. Every major index has a UCITS compliant European equivalent. Here are the direct replacements. VOO becomes the Vanguard S&P 500 UCITS ETF. Ticker VUSA. QQQ becomes the iShares NASDAQ 100 UCITS ETF. Ticker CNDX. Same underlying indices. UCITS structure. Legal and available for European investors. When searching for ETFs, always filter for UCITS and check the ISIN, the unique fund identifier. Irish domiciled UCITS ETFs always begin with the letters IE. If the ISIN starts with IE, for example IE00B 3XXRP09, which is the ISIN for VUSA, the fund is Irish domiciled and UCITS compliant. If it does not start with IE, check the domicile carefully before buying. Checkpoint 5. Physical versus synthetic. The final checkpoint. How to invest in ETFs correctly means understanding what your ETF actually owns. A physical ETF, also called a full replication ETF, actually buys and holds the stocks in its index. An S&P 500 physical ETF owns shares in all 500 S&P 500 companies. What you see is what it holds. A synthetic ETF does not own the underlying stocks. Instead, it uses financial instruments called swaps, agreements with a counterparty, typically a bank, to replicate the performance of the index. The ETF does not own Apple or Microsoft. It owns a contract that promises to deliver Apple and Microsoft's returns. Synthetic ETFs can be slightly cheaper and can track their index more precisely, but they carry counterparty risk. If the bank providing the swap fails, the ETF's ability to deliver its promised return is at risk. For most long-term investors, physical replication is the simpler and safer choice. The label to look for: physical or full replication in the ETF's fact sheet. If it says synthetic or swap-based, understand what that means before buying. 5 checkpoints. 5 decisions that most investors never make consciously. Mike Petrie has made all 5. On Nobody Told Mike, he talks about the philosophy. Here are the technical decisions behind it. Accumulating. Mike holds accumulating ETFs in his growth portfolio. Dividends compound inside the fund, tax-deferred, uninterrupted until the income phase begins. Irish domicile, where possible, Mike selects UCITS ETFs domiciled in Ireland to minimize U.S. dividend withholding tax. UCITS compliant. All ETFs in the Nobody Told Mike portfolio are UCITS regulated. Available, legal, and appropriate for a European investor. Physical replication. Mike's core ETF positions are physically replicated. He owns the underlying stocks, not a swap agreement. Low TER, the growth ETFs in his portfolio carry expense ratios below 0.25%. The S&P 500 position even lower. This is the complete guide on how to invest in ETFs as a European investor. Not just the concept, but the 5 decisions that determine whether you are doing it correctly. If you are investing for beginners and want to go deeper on the philosophy behind these decisions, Mike Petrie covers all of it on Nobody Told Mike. The best ETFs are not just about the index they track. They are about every structural decision around them. Here is the question for the comments. Did you check all 5 of these before buying your first ETF? Or are you going back to review your holdings after watching this? Be honest. If this breakdown clicked for you, subscribe here for more NTM explainers. And watch Mike explain the ETF story himself. Nobody Told Mike, Episode 1. Link below.